This is the second video on behavioral finance. Now we are going to discuss the analysis of relevant information. So whenever any investor is doing the analysis of relevant information that may exhibit some behavioral, some emotional factors. Technically, decisions should be based on relevant information. Investors should consider all the information, including the past, including the current, including the information related to the future. But sometimes investor may use information that is not relevant but is readily available and possibly to simplify the decision making process. So if investor does not base its decision on the current information or the information related to the future and only base its decision on the past information, that means that analyst, that investor is showing a behavior of anchoring. Anchoring is if you anchor to the past, if you still holds on to the past. For example, investor may buy shares that in the past have had high values on the grounds that these represent their true potential values, even though rational analysis suggests that prices of these shares will remain low in the future. So because of the past event, you have bought the shares and you are not updating the information. So that is anchoring. Anchoring is if you are not updating your information based on the current circumstances and you are still looking at the past, that is anchoring. So many of us, while buying the shares, buy the share on the basis that this share was good in the past. So if you buy the Nokia shares because Nokia was one of the leading manufacturers of cell phone, so that is wrong. That is anchoring. What is the current situation? You should know this. If you are buying the share based on the past information, based on the past high values, that is anchoring. Investor may also believe that probability of a future outcome will be influenced by how often the same outcome has occurred in the past. A non-financial example of this idea would be the situation when a coin is flipped 8 times, comes up as tails every time, and it is said that heads is more likely the 9th time. We often, for example, there is a cricket match between two teams and your captain has lost the toss 5 times in a row. So in a 6th match, you will bet that this time the captain will win the toss. So this is gambler fallacy, to be honest. Whenever you flip the coin, there is always a 50% chance that you can win or you can lose. It will not guarantee that if you are winning 5 times previously, now you will lose. Or if you have lost 5 times previously, now you will win. If the value of a company share has risen for some time, investor will be using similar logic to the coin example. If they sell those shares on the ground that these shares have already gained enough, now the price will go down. And similarly, some of the investors are thinking that in the previous time period, the stock price has fallen. Now it will go up. Why? Because of the gambler fallacy. Why? Because previously, in previous days, it has fallen. Now it will go up. Previously, it has gone up. Now it will fall. This is gambler fallacy. This is not based on any true event. You are thinking that, okay, in the last 5 days, stock has fallen. Now it will go up. In last 5 days, stock has gone up. Now it will go down. This is gambler fallacy. This is emotional thinking. Another deviation from rational analysis is the herd instinct. If you do not do your own analysis, if you blindly follow the others, that is herd instinct. Where investors buy or sell shares in a company or sector because many others are already done so. Explanation for investor following a herd instinct include a social conformity, the desire not to act differently from others. Following a herd instinct may also be due to individual investors lacking the confidence to make their own judgment. So if the large group is buying one stock, you will also buy that stock. Sometimes you can make money of that, but many of the time what will happen, you will act late and all the persons have already bought at the lower price. When you are buying at higher price, then the price can go down. You will end up in making losses. So if many investors follow a herd instinct to buy shares in a certain sector, for example IT, this can result in a significant price rises for shares in that sector and lead to a stock market bubble. But the point is, for example, stock price is going up and everyone is buying. If you bought here, then you will make money. But if you bought here and then stock price start declining, you will lose money. So herd instinct is, without doing your own analysis, without doing your own rational thinking, without doing your own judgment, if you blindly follow others, that is herd instinct. Even in our country, many of the people follow this. I know in early 2000s, MBA was very popular, so everybody was doing the MBA. Computer science was very popular, everybody was doing computer science. In less developed areas, medical and engineering were very common. So every kid who was in high school, the kid's aim was to get admission in MBBS or the engineering. That is the herd instinct. Without doing judgment, without following your thinking, without doing rational analysis, if you follow other, that is herd. Investors may not therefore base their decision on a rational analysis, but there is also evidence to suggest that stock market professionals often do not do so either. So studies have shown that there are traders in stock market who do not base their decision on fundamental analysis, and those are called noise traders. Noise traders are those traders who do not base their decision on rational analysis, who follows others, who follows their decision based on some charts, some history. So characteristics associated with noise traders including making poorly timed decision, following trends, chartism, using analysis of past share price. So this is the example of noise trading. So if you follow the history, if you follow just the old news, if your decision is poorly timed, if you base your decision like the stock went up in last January, it will go up in this January. So this is the noise trading. Fund manager may also be subject to behavioral influences. Fund manager who wish to give the impression that they are actively managing their investment portfolio may periodically reposition their portfolio to new sector. This is quite different. For example, you are a investor and you have given your money to the fund, and that fund manager has invested in, for example, Apple, Meta, Facebook stock, Alphabet, Google stock, and your fund is performing very well. Like fund is performing 20% return, and in every year you have invested in the same stock and fund is performing well. What will happen? People will start asking, you have invested in 3 companies. We also know these 3 companies. We can invest directly. Why we are paying you the fee? So in order to avoid this question, what fund manager will do? Fund manager will keep on reposition the portfolio. Fund will sell Apple, buy other stock. Fund will sell Meta and buy other stock. Fund will sell Alphabet and buy other stock, just to give the impression that we are doing something great. So this is just a behavioral factor. Maybe because of this, you can impress the investor, but you may end up losing money. So fund manager may also subject to behavioral influences. Fund manager who wish to give the impression that they are actively managing the portfolio may periodically reposition the portfolio to new sector, even though the old sector continue to generate good prospects, good results. Some fund manager also ignore companies with low market cap. Low market caps means small companies with the result that their shares are not purchased and their values remain low, known as small capitalization discount. So fund often invest in the big top companies. They do not invest in small companies. And because of that, small companies remain still the small. So these are the behavioral, emotional factors which investors can show while analyzing the relevant information. To be honest, these are few examples. There are many others.